Welcome back, everyone. This is our weekly oil review. My name is Angelo Zittis. The title for this week is Oil Prices Stay Low Key. Now, oil prices remained rather steady in the latest daily sessions, trading below the $30 per barrel level, as the general market sentiment remains in a pessimistic position. During the past days, more governments and central banks stepped up to impose fiscal stimulus and monetary policy actions, indirectly implying that economic activity could be in for further deterioration. Of course, the happenings affect the energy market and specifically the oil market, as demand is expected to be on the back foot. Other fundamentals are also affecting oil's price, and this report aims to briefly outline some of the most important matters concerning the industry. In the past days, the weekly readings regarding the oil market provided mixed signals once again. First, the Baker Hughes oil rig count from the US released last Friday indicated a significant drop from 683 to 664 active oil rigs. That's a reduction of minus 19 oil rigs in 1 week, while such a large weekly drop has not been seen since the 26th of April 2019. The drop in oil rigs is considered a sign of weakening demand for the oil market. Moreover, the weekly US stockpile readings from the API and the EIA released in the past days indicated a minus 1.25 million barrel drawdown and a plus 1.62 million barrel surplus correspondingly. The two figures basically cross out each other and do not provide much information. We are also receiving information that major US oil producers like ExxonMobil is cutting down its production and refinery activities lately due to the lower demand, but also due to reduced personnel on the production sites. The lockdown taking place in most countries keeps not only demand but also the oil producing activities in check, as the people needed in order to carry out most of the procedures are not available. Thus, output is diminished. On a normal working basis, it is estimated that contract workers at the site are usually 2,000, and that during the past weeks, 1,800 had not showed up for work. In any case, in the US, companies may also be pressured to cut down general expenses due to the very low oil prices at the moment. So in this case, oil industry has been hit by both matters, low prices and the lockdowns attempting to curb the spread of the coronavirus. On the oil demand front, things are not looking to get better anytime soon. Analysts and traders expect lower demand to continue to drive the markets worldwide in the second quarter of 2020. The reason is mainly attributed to the lockdown, which has cut unnecessary movement and significantly reduced road travel. The largest countries in Europe, Germany, France, and Italy do not allow people to move around unless it's absolutely necessary. Also, lately, India was among the latest countries to enter a 21-day lockdown. Those are already two large continents in a lockdown without counting the US. Note, India is the second largest importer of oil globally after China and is an extremely populous country. On a separate note, the rivalry between Russia and Saudi Arabia seems to continue, and the OPEC Plus group seems to remain divided. According to a new report by Reuters, Russia plans to crank up its supplies, attempting to regain and increase its market share. Analysts believe the OPEC Plus group could be heading for more trouble, as the lowering demand expected in the next months could force the team to reconsider their overall strategy. As a conclusion, we wouldn't be surprised if oil prices see some advancement in the next days, as the optimism from the economic measures to be announced in the US and other countries could lift the general sentiment and the commodities price simultaneously. Yet, the overall news from the oil industry remains rather bearish for the medium to long term, in our opinion. Moving now to our technical analysis, this is WTI Cash daily chart. Now, crude oil is currently trading between our R1 28.45 resistance level and our S1 24.50 support level. We would like to place specific emphasis on our S1 24.50 level, as it has been holding up for the past 3 consecutive daily sessions. However, our levels lower are the S2 22.45 line and the S3 20.50 hurdle. If the market favors a bullish run for the commodity, the levels to the upside are first the R1 28.45 that was tested on the 19th and 20th of March but was not breached. However, even higher we have the R2, that's the 30.60 level that was last seen on the 17th of March. And above that we have the R3, that's the 33.40 line, which is also a possibility if the bulls are strong enough. Generally, crude oil remains in a selling momentum, and this is also confirmed by the RSI indicator below our chart that is running through the 30 level. That's the end of this report. We would like to advise caution when trading the markets. Thank you very much for your time. Enjoy solid trading.